I'd like to thank everybody for joining me today. Well, it's that time of year that everybody's worried about their taxes. As December 31st gets closer, that becomes a hard deadline for most taxpayers. And you've either done your tax planning this year or you didn't. If you want to reduce that tax bill, you've got to do most of that planning in the current year. So we've got a huge deadline coming and we've got to be aware of it. When you look at taxes, especially from the income tax side, we've got ordinary income tax and capital gains. Those are the things that we're usually worried about, before December 31st gets here. And as you look at how we can eliminate those taxes, we have to look at both types of taxes to make sure that we're getting both the capital gains tax eliminated, the ordinary income tax, and there's rules of how you can eliminate some, capital losses can only go against capital gains in most cases. And so a lot of times we're looking for ordinary deductions, ordinary losses that can go against both ordinary income tax and capital gains. So when you look at tax planning, you're always looking at, can you eliminate the tax legally? And two, the next one is, can you reduce your marginal tax bracket? Can you drop it down so instead of being at the top marginal rate, maybe you can get that into something lower? If you can't eliminate the tax, then we always look at, can we defer the tax to a future year? And not only when we look at that about the deferral, it's looking at, can we do it? But we should also ask the question, should we defer that tax to the next year or to the future? And so we have to make sure there's a balance both now and ongoing to what we want to accomplish. When we look at income tax strategies, especially, for W-2 employees, are you maxing out your qualified plans? A lot of times we're thinking of traditional IRAs, defined benefit plans, 401ks, true tax deferral. But remember, we also have Roth IRAs. With a Roth IRA, you're going to pay the tax now. You're going to put the money into the account after tax, but everything in that Roth is going to grow tax-free and can be accessed tax-free in the future. So there again, do you want to pay on the seed or the harvest? Do you want to pay a little bit now to get a big benefit later? Versus the traditional IRAs, other qualified plans, we're looking at deferring that tax now. There again, maybe bringing us down to a lower marginal tax rate, eliminating that tax now so we have better cash flow, but knowing we've got a big tax bill in the future. We've got a partner called the IRS that's going to be hanging around until that money comes out of that account. As you start looking at these different accounts, traditional IRAs, 401ks, profit sharing plans, defined benefit plans, 412(e)(3) defined benefit plans, all of these plans, it comes back to how much do you want to put away? And if you're a business owner, are you okay with putting more money away for yourself, knowing you've got to put more money away for your employees too? So all of these have some very good pluses and minuses to them. We just have to get the plan that fits. And that's usually starting with the type of business you have, your employees, when they were hired, what they're being paid, so we can design a plan that's best for you. When we're getting down to December 31st and this tax planning, this is when a lot of charitable planning happens as well. With charitable planning, this is going to be an itemized, deduction on your personal tax return. You can also take charitable, deductions in your business and in your estates and trusts. As you look at charitable planning, there's a lot of advantages for charitable planning. The tax code's designed for people to want to give to charities. There's things that charities can do that government can't do. And so that's why the government encourages charitable tax deductions. And there again, it comes back to, if you want to keep it simple, make a direct gift to charity. Now, if you're making a direct gift, you can look at it and say, okay, I'm going to, donate, $10,000 to my church. Okay, you can do that. You can write a check, but also take advantage of some opportunity here. If you've got 10,000 in appreciated stock, go ahead and donate that 10,000 of appreciated stock to your church. You get a $10,000 tax deduction, and you don't have to pay the tax on the appreciation in that stock or stock account. And if you love the stock, if it was Apple stock and you want it back, okay, January 1st, go buy it back. Use the 10,000 in your checkbook to buy it back. It just creates more tax efficiency for you versus writing them a check. And then when you need the 10,000 from your stock account, you have to pay the capital gains or appreciation on that stock. So look at where it is. Then also look at charitable remainder trust or charitable lead trust. Do you want to get a benefit back in the future? So you can do a charitable remainder trust, donate property into that trust, get a big tax deduction now, and get income for the rest of your life or joint lives. Charitable lead trust, you can provide a benefit to the charity, say over the next 5 to 10 years, then you get the principal back. So there's more planning you can do, just depends on what you're trying to accomplish. When we do a lot of business, planning and tax planning within the business, this opens us up to a lot of other opportunities that we can't take if you're just a W-2 employee. If you have a business, maybe you're in a successful, profitable business, maybe a captive insurance company. If you're investing in real estate and you've got buildings that you've acquired in, more recently, maybe we can accelerate your depreciation deductions with the cost segregation. There's research and development credits. Also, when we're doing future planning, as you exit, maybe we look at doing an ESOP to create a tax-free environment for your business going forward. Other things that we want to look at, it's not now between now and December 31st conversation, but early in the next year, we may want to, convert you from a partnership or sole proprietor to an S corporation or a C corporation. Or if you're currently an S corporation, maybe look at doing a C corporation. So there's planning we can do now. There's planning that we want to do to set up for the next year. Now, when we're looking at future planning, with future planning, we're always looking at how can we reduce our taxes in the future. And if you look here, with life insurance, I like using life insurance as a Roth lookalike. The problems with a lot of Roth accounts and people that are doing Roths or want to do Roths, they can't put enough money away either to be meaningful for their situation or to accomplish what their goals are and objectives are for the future. So we can use a properly designed life insurance policy. And that life insurance policy, if it's designed right, all of the growth inside of the policy can be tax deferred, but you can access that income, access the principal of that policy tax free. Now that there again mimics a Roth, but we really don't have the limits of how much we can put in. It's up to you. How much do you want to put in? And then we'll back in and design the policy. Other things I like about the life insurance, especially as we're planning for the future, we've got that tax deferred growth, we've got that tax-free access, but remember we've got a death benefit there. So a lot of planning time, times during the planning process, we don't think about what if. What if somebody dies early? Is the family protected? Well, if you put $1,000 into a Roth account or into a qualified plan account, well, and you die premature, the family gets $1,000. Maybe some extra growth in there, but not a lot. With a life insurance policy, it's not the 1,000 that you put in, but it's also that death benefit that could be 10 times, 100 times what you've put in there. So it just creates leverage to protect the family while we're doing the other planning now. The other parts of this is we can also create that death benefit to be estate tax free, and if you need it to be creditor protected. So there's opportunity there as we're doing our tax planning to also look at our future planning and see how can we organize a little bit better for the future. So going into the future, we've got tax deferred buckets, we have tax free buckets, and we also have buckets of money that we can tap anytime we need for that what if situation. So I appreciate everybody getting on. If you have questions, feel free to reach out. If not, we'll talk again next week. Thank you.